Greetings, my beloved clients and friends. Just wanted to give you a market update. Today's Good Friday, April 15th. And so, about a week ago, Powell's, Fed Chair Powell of the Federal Reserve, he made it very clear that he's going to aggressively combat inflation. And there's a good likelihood that the next time he raises rates, it'll be at a clip of 50 basis points, and maybe the next few, to really rein in inflation. And so that was kind of more than the market expected, and the market did not react very favorably to that. So, like I've been saying all year, this could be a very challenging market environment. And so what he's doing is very similar to what Fed Chair Paul Volcker did in 1981. Inflation was just raging back then. Mortgage rates were like 15%. Bank accounts were paying 15, 18%, right? And inflation was just really bad. It was really stagflation, meaning a stagnant economy and inflation. So he raised rate. The reason rates were so high is because he raised them to break the back of inflation, knowing that he was going to push the economy into a recession. And Powell is kind of talking the same way. He's like, you know what? If we push the economy into a recession, we push it into a recession, but we're going to break the back of inflation. If the market takes a hit, the market takes a hit, but we're going to break the back of inflation. If we if it affects the housing market, it affects the housing market, but we're going to break the back of inflation. So he's really aggressively going to doing what he can to rein in inflation, and it could be a very challenging market going forward. Now the market has kind of trickled down, but it's not like it's a like someone said, gun in a movie theater. I mean, they're not flooding the exit gates. Okay, so, and I think that kind of bothers him because I think he wants the market to cool their heels, but the market is kind of taking everything in stride. It's off a little bit, and I think, but if you look at the volume, it's not very high. It's very normal type of volume, but the trend is down as far as the prices go. Now, I think one other thing that is exacerbating it is that Monday is tax day, and there's a lot of people going to have to write a big check, including many of my clients. And one reason is that in 2020, when COVID hit, and federal governments and federal banks flooded the economy with liquidity to prevent an economic crisis related to COVID. And we saw that, and we took advantage of it, and we had a huge year in 2020. We started buying things that would really benefit from that, and I think the portfolio was up about 90% in 2020. Okay, throughout that year we were buying, we were not selling. So we had these massive gains, and we did not have to pay tax on them because we weren't selling, we weren't realizing those gains. And then in 2021, it kind of started to cool off, and the most aggressive segment of the market kind of peaked around January, February timeframe, and then it started spreading to other parts, peaked in November. And so through that, we were selling, we were realizing those gains. And when you realize the gains, that's when you pay the tax. So now we're paying tax basically for 2 great years of gains. And we're paying the taxes at a time where the market's pulled back. So it's a little bit painful. And a good chunk of the gains that I realized last year were at the beginning of the year. in January and February. In January, Tesla peaked. In January 28th, GameStop peaked, and we took huge gains on those two positions. And for the rest of the year, I had it in the back of my mind, like, man, taxes are gonna be ugly this year, and other things that I wanted to sell, I was a little bit hesitant because, like, man, I'm already gonna give them a big tax liability. I don't want to make it a lot worse. And so we did some selling, and we took other gains, and you know, tried to manage the portfolio best as we could, but maybe we're a little hesitant in selling because we knew it was already going to be bad tax-wise. So, so a lot of people are paying taxes right now. So I believe that's also contributing to the weakness of the market as we're in the first half of April. And I'll tell you a story. Back in the 90s, I worked in Newport Beach, and April was always a slow month, because I'd call clients with a good investment idea, say, hey, we've got this and it looks pretty good. How much do you want to put in it? And I would hear the stories like, oh, I got to write a huge check on April 15th and I don't have any money, right? Because rich people pay taxes. And in April 15th, a lot of them had to write really, really big checks. And so as a result, not a lot of them were interested in investing in April. Okay, so we're in a year right now where a lot of rich people have to pay taxes this April, and they're not investing, right? So that could contribute to not a lot of money coming into the market and actually some money coming out because they have to sell stuff to pay taxes. So I think that's part of why we've had a slowdown the first couple weeks of April. Obviously, Powell's stance has also contributed to that. So those two contributing factors. Now, I'll tell you this. So when I was working in Newport Beach, April was, like I said, sometimes a tough month. May as well, if they had to pay a lot of taxes. But guess what? By June, those people had money to invest again. So I believe that's going to have an impact on the markets. These people are licking their wounds from the big checks they're having to write to pay their taxes. But by June, money's going to start coming in again. I imagine. Now, Powell tightening, that's going to put pressure on the markets, because there's a saying, never bet against the Fed. And right now, the Fed is wanting to pull things back. So we don't want to bet against that. Now, so what do we do in reaction to that? And this goes back to the taxes, and why we're not just in and out and selling and going to cash. Because as you can see, if we sell and we go to cash, we're going to have to pay a lot in taxes. Okay, so if I think that there's a strong likelihood that there will be a stock or the market will go down, I don't always sell, because if I sell, I guarantee a 25% haircut, because of taxes. So if it turns out that things only went down 10%, I should have just let that ride, rather than guarantee a 25% tax payment, right? So even if I think there's a likelihood that the market's going to pull back 20%, should I sell and lock that in, but also lock in a 20% surcharge to the government in form of taxes? So it'd really just be a break even. I could have just watched it fluctuate down 20% and then from there go back up, or sold it high, paid the taxes, and then, if I would have executed it perfectly, I'd sell high, pay the taxes, get back in after the 20% drop, and guess what? The clients only broke even. There was really no advantage to that. It might look good on paper, but there's really no advantage to that. So for that reason, even when we see weakness in the market, we just don't rush to sell. I mean, unless it's going to be more than, there's a strong likelihood that the pullback's going to be more than 25%. A lot of times it's better just to ride through it because of the taxes. Because if you sold, you'd have to be right twice. You have to be right when you sold and when you have to be right when you bought back in, net of taxes. And that's really hard to do. If it's a great company, a lot of times you're better off just weathering the fluctuation and avoiding the taxes and avoiding trying to be right twice in timing the top and timing the bottom, which is very difficult to do. So that's the challenge that we have, and those are the thoughts that we have in the office when we're looking at, what do we sell now, or do we just let the portfolio fluctuate and not create a lot of tax liability. So we give a lot of thought to that. And so what can you do? One alternative would be to hedge the portfolio, meaning holding all the assets, but then also buying something that would go in the opposite direction, which we've done in the past, and we're very close to doing right now. So that way you don't have to sell your underlying assets. You just buy something that, if there was a big pullback, it would benefit greatly, and it would offset or partially offset the pullback in the rest of the portfolio. So we're getting to that point, and we're this week we were looking at what instruments should we use in order to hedge, and because we went from being very pro-growth in 2020, and then in the second half of 21 we kind of got back more neutral and even defensive, and now we're getting close to being aggressively defensive. But earnings seasons is coming up right now, and it should be interesting because it seems like earnings are still pretty good. It seems like the economy is still pretty good. So we're just going to navigate through it. So basically, what I'm saying is, when you make money, you pay taxes. And when you have portfolios that have good returns, they come with fluctuation. So there's really no way to avoid taxes. There's no way to avoid fluctuation. Well, there is, if you want to make no money, right? Which the accountants advocate, right? I've been getting calls from clients, accountants, and they're like, "Man, you gave this client a huge tax liability," and I'm like, "Well, you're welcome. That means we made him a lot of money," right? I'll tell you another story. When I started in the business, and I started really making good money, I think around the end of 96, beginning of 97, I got my first big paycheck. It was like $35,000 one month. And I was excited, like, man, can't wait to payday to see that big check. And then I see my check, and well, gross was 35, but net, I don't know if it even made it to 20. It was right around there. So they took a huge chunk out of my paycheck, and it was like painful. And I called my boss and I complained. I go, "Hey, what can I do about taxes? I saw my paycheck, and did you see how much they took out?" And this is what my boss did on the phone. He clapped and he said, with a chuckle, "Congratulations. You no longer have a money problem, you have a tax problem. And that's way better." And he didn't make me feel better, but he was right. And so I don't want to laugh because my clients have a tax pain right now. But it's better to have a tax problem than a money problem. And we're paying taxes because we made a lot. And so there's really almost no way to avoid that. So when I look at what we do for our clients, if net of fluctuation, right, net of occasional drawdowns, net of taxes, we're growing and preserving your wealth at a clip of 15% a year over 3, 5, 10-year period. You're welcome. I mean, that's what we're trying to do for our clients, and it's better than, in my opinion, having no fluctuation and no taxes in a savings account and not preserving your wealth, or not. So the way we manage money isn't for everybody, but if they could stomach the fluctuation and occasionally, when we make money, we're gonna have to pay taxes. Net of both of those things, I think you'll be very well off. Now, the other alternative is to sell nothing, and one thing you take to your grave is your cost basis, right? So, but then you didn't enjoy any of your money; it all went to your heirs. So we want clients to grow and preserve their wealth, but also to enjoy their golden years, take some money, and if we made you profits, spend it and have a nice retirement. So that's our philosophy. And when you see the big picture, and I mean, we think about, when we're selling, we think about the tax consequences, and is it really worth it to sell and realize the gain, or just deal with the fluctuation. All those things go into our decision-making process. So I hope that helps, and hopes gives you perspective on how net of fluctuation in taxes over time, we're still just trying to do a good job to grow and preserve your wealth over time. And I think over time, if you could stomach those things, you'll be happy with the results. All right, so, and happy Easter to everybody. I hope this was a help, and we'll be talking again soon.